Today we're tackling a topic that's honestly causing a lot of anxiety out there, navigating the very real fear of a massive market crash, but doing it through rational preparation. It's funny, every generation kind of tends to believe the biggest financial crash is squarely behind them, right up until the exact moment the next one shows up at the door. Which brings us to a terrifying question that's literally on everyone's mind right now. What if the next stock market crash is actually worse than 2008? Let's rewind a bit. Think back to the mindset right before the 2008 global financial crisis. People genuinely believed that century-old institutions, places like Lehman Brothers, were simply too strong to fail. No way they go under, right? Then the crisis hit. Markets absolutely collapsed. Banks failed. And trillions, literally trillions of dollars in wealth just vanished into thin air. It taught investors a super painful lesson. Things that seem completely impossible absolutely can and do happen. But hey, right off the bat, let me assure you, this is not about fear. We aren't sitting here trying to predict the end of the world, and we're definitely not here to panic. Think of it like this. We're here to build a sturdy shield, not just panic about the oncoming storm. What this explainer is really about is understanding your risk and pinpointing your vulnerabilities. It's all about swapping out that panic for practical, actionable knowledge. Section 1. The next crash myth and why history doesn't repeat itself exactly. A huge mistake I see a lot of investors make is expecting the next big crisis to look exactly like the last one. It's kind of like fighting the last war. While the 2008 crisis was overwhelmingly tied to housing, crazy amounts of leverage, and banking institutions, the next major downturn, it could stem from completely different triggers. We're talking mounting debt, sudden massive shifts in geopolitics, huge technological disruptions, or even major government policy mistakes. Honestly, it could be something no one is even whispering about right now. And that is exactly why experienced pros don't just stare in the rearview mirror at the last crisis. Instead, they hyper-focus on current vulnerabilities. That leads us right into Section 2, 4 warning signs. These are the specific vulnerabilities the experts are actually watching. Okay, warning sign number 1, massive debt levels. Now look, debt all by itself isn't automatically the bad guy. Businesses, governments, everyday consumers, we all use debt as a functional tool. But the trouble starts brewing incredibly fast when your borrowing outpaces your ability to actually manage it. Imagine just borrowing more and more money while your actual income growth completely stalls out. Eventually, that pressure just builds and builds. Investors watch these massive debt levels super closely because high leverage acts like a magnifying glass. It drastically amplifies economic problems during rough patches, turning what could be tiny little hiccups into massive cascading failures. Warning sign number 2 hits when asset prices become totally disconnected from reality. You know the vibe, when markets get extremely optimistic and investors start believing prices can literally only go one direction, up. Suddenly, risk seems totally invisible to everybody, valuations get stretched way past making sense, and speculation just runs wild. History consistently proves that this kind of excessive optimism sets up an intense vulnerability. It's not that economic growth itself is bad, obviously, but when expectations become totally detached from reality, the inevitable disappointment hits the market incredibly hard. Moving on to the third sign, and this is a big one, global interconnectedness. We live in a modern economic state where a localized problem in just one single country can rapidly spread across entire continents. I mean, our supply chains and financial systems are so intimately linked today, markets react to news almost instantly. And while this interconnectedness creates incredible efficiency when times are good, it also means that financial stress spreads much, much faster than it ever did for our parents or grandparents. A local hiccup somewhere can literally become a global crisis overnight. And the fourth warning sign is perfectly captured by the 4 most dangerous words in investing. This time is different. We humans, well, we have this incredible capacity for financial amnesia. Technology evolves, sure, markets change, but human psychology, it remains remarkably consistent. Emotions like fear, intense greed, panic, and extreme euphoria have driven market cycles for literally centuries. Every major financial bubble in history tends to feature this exact same trap. People start thinking the old rules somehow don't apply anymore, the risks don't matter, and prices are just going to keep rising forever. But history repeatedly proves those emotions wrong, time and time again. Alright, moving to Section 3, the ultimate market danger, because the real threat isn't actually the crash itself. Watch how this cascade of panic actually builds up in real time. Step 1, the market falls, say 10%, and naturally fear starts bubbling up. Step 2, it falls 20%. Step 3, Now the news headlines become absolutely terrifying, end of the world stuff. Which leads us to step 4, emotional selling completely takes over. Investors panic and just smash the sell button on everything. And the kicker? They don't do this because their underlying strategy changed or because the core businesses they own are suddenly broken. Nope, they do it purely because emotions took the wheel. The absolute biggest danger you face as an investor is this emotional response, locking in your losses at the exact worst possible moment. This panic tax often ends up being way more expensive than the actual economic downturn itself. So let's look at section 4, how smart investors prepare. It's all about the mindset pivot, from prediction over to preparation. The absolute most crucial point to remember here is that preparation matters infinitely more than prediction. When millionaires and highly experienced investors stare down market uncertainty, they aren't sitting around trying to predict exact crash dates. Honestly, because nobody consistently predicts crashes, it's a fool's errand. Instead, they focus purely on preparation. They ask themselves, what if I'm wrong? What specific risks am I exposed to right now? Can my portfolio survive a major downturn? It's just a much more powerful and frankly empowering mindset to have. Lesson number 1 from the Pro Playbook: maintain liquidity. You'll notice many wealthy investors always keep cash readily available. And actually, scratch that. It's not because they hate investing, it's because incredible, once-in-a-decade opportunities always appear during market stress. When everyone else is panicking and being actively forced to sell off assets, investors with liquid cash have choices. Cash gives you flexibility, and man, that flexibility is incredibly valuable when everything else around you is uncertain. Lesson number 2 is to focus relentlessly on quality. This means prioritizing companies with specific traits, strong balance sheets, healthy cash flow, durable business models, and major competitive advantages. Look, weak businesses are the ones that struggle the most when the economy gets stressed out. Sure, strong businesses might still see their stock prices dip during a crash, that's normal, but they have a vastly better chance of actually weathering the storm and recovering. Prioritizing these quality traits doesn't magically eliminate your risk, but it dramatically improves your overall resilience. Lesson number 3, think long term. There is such a stark contrast in how different investors react during a downturn. Short-term thinkers, they obsess over day-to-day fluctuations, basically panicking at every single red arrow on their screen. Long-term investors, however, look years into the future. They pause, take a deep breath, and ask themselves, hey, will this company still be relevant in 10 years? Does the long-term story still hold up? Adopting that broader perspective dramatically cools down the sudden urge to make really bad emotional decisions. So let's simplify everything we've covered in our playbook today. We counter the warning signs, things like high debt, elevated prices, interconnected risks, and dangerous human psychology with really clear, actionable steps. Maintain liquidity, focus on quality, and always think long-term. Now, history doesn't give us any guarantees about what the next crash will look like or exactly how big it'll be, but it does guarantee one thing for sure. Severe market declines are just a normal part of the economic cycle. Managing your risk and staying disciplined with this playbook, that's exactly how you adapt and thrive. Because think about it, the stock market has survived world wars, severe recessions, pandemics, and total global panics. Every single crash feels terrifying and completely unique in the moment, and it always convinces a whole lot of people that recovery is somehow impossible this time. Yet, the economy always adapts over time. So stop agonizing over the exact date of the next crash. Instead, focus on building your knowledge and managing your risks. Because the most important question isn't, will a crash happen? The only question that really matters is, are you prepared for when it does?